I think we're ready. I think we are. Am I live? Good afternoon, everyone. Can everyone hear me? My name is Mark Skinner. Welcome to, if you know, Economy Extended Stay. I'll run through a few numbers, and then we'll get introductions from our panel. And feel free, if you have a question, if I can see you, that is, raise your hand. I mean, it's a bit blurry, but we'll get it working. So let's see. Okay, an extended stay hotel, fully equipped kitchenette in each guest room which accepts a reservation and does not require a lease. That lease differentiation separates extended stay hotels from corporate or serviced apartments, which are usually built on residential land and therefore have a minimum stay of 30 consecutive nights. They are not included in our database. This is just extended stay hotels. And as you can see, 575,000 rooms in the US, about 10% of room supply. Just to put things in perspective, $14.4 billion in room revenues in 2024, and then we saw more than a $5 billion drop in 2020, and the recovery was very, very fast. 1 year, and all those revenues lost during the COVID pandemic in 2020 were rebuilt. A very strong increase the following year, and now they have basically doubled, and we're increasing at about $1 billion a year. To put that in a historical perspective, that was about the same annual increases as you got 2017 and 18. So please tell us about yourselves and your brands. Liz, would you like to go first? Ladies first? You knew that, didn't you?
I'd love to go first. Hi, my name is Liz Huber. I'm with Extended Stay America. So I'm the Chief Operating Officer. We own and manage about 600 extended stay hotels, and then we franchise just over 100. So we have 3 different brands. We have a Select Suites brand, which really falls more to the economy. We have a Suites brand, and then we have a Premier brand that really fall more to mid-scale. All in, it's about 70,000 rooms. Isaac, would you like to go next?
Hey, everyone.
Excuse me, interrupting one second. Avi, could you start that timer, please, that we can see here, that nobody else can see? Because otherwise we'll be talking until dinner time.
Hey, everyone. My name is Isaac Lake. I'm with Hilton, brand leader of our newest brand, Live Smart Studios by Hilton. And we have, at current, around 350 active deals in the works for the Live Smart Studios brand.
Thank you. Gary DeLapp, President and CEO of Stay PT Suites. We launched the brand the month before COVID hit. So, in fact, it was right here in Hunter at that time. We now have 40 hotels open by the end of the year. Roughly a quarter of those are franchise, and the 75% of them are corporate owned. And we expect to have 10 open next year. We have 50 in the pipeline.
Thank you. Richard?
And thank you, last but not least, right, Mark?
You're going first on the next question.
Absolutely. So my name is Rick Schaefer. I am the Vice President of Franchise for Red Roof. Under the Red Roof umbrella, we have Red Roof Inn, we have Red Roof Plus, we have Hometown Studios by Red Roof, which is our extended stay brand and why I'm on the panel here today. And then we also have a soft brand called the Red Collection. We have just over 60,000 rooms and over 700 locations coast to coast.
Thank you. Okay. See if I can get this to work. Okay, there you see, this is the segmentation of brands that we use in our reports. Economy, average nationwide ADR $75 and below. Mid-price segment is $75 to $135, and upscale is $135 plus. I should emphasize that this segmentation is for reporting purposes only. There are some very dominant brands here that if we narrowed it down into further segments, we would be breaching federal guidelines on reporting benchmarking data. And also, if you look, for example, in the mid-price segment, $75 to $135 is a big difference. So if you happen to fall in the mid-price segment there and you're at the lower end, does that mean you don't compete with economy properties? No, it doesn't. Once again, this is just for reporting purposes only. And you'll notice that 5 of these brands are written in red. I don't think any of them have any rooms open today, but they're all under development. Most of them are backed by very large hotel companies. The single most common question I get asked about extended stay today is, what about all this new supply? What's the risk? What do you think, Rich?
Sure. So there's always inherent risk when you see the level of new brands that are coming into the marketplace. But I think it's about segmentation. Where are these brands coming in? In our particular case, we're in the economy segment, and there's tremendous room for growth in that segment of the industry. Whereas the mid-scale, I think it's getting tight. Upscale can go either way. I mean, upscale can go with that true extended stay model, or it can go transient. So I think the mid-scale is where you're seeing compression, where you really need to think about it more than in the economy or upscale.
Thank you. Now, if you look at these, whoops, wrong way. If you look there, I mean, these brands are sort of clustered, if you would like to say, upper economy, lower mid-scale, and maybe in a couple of years we'll be able to do further segmentation on the market. New supply, Gary, risk?
Yeah, I think
macro?
Yeah, from a
micro
macro perspective, I mean, I just look what we've accomplished in getting 40 open by the end of the year. You look at all the other brands that have been rolled out, no one's even close to that. And I think with this, the way the construction costs have been, interest rates, the situations are very unstable from that standpoint, from a financial standpoint. I don't think there's any, in my view, any concern of oversupply in the immediate future. I think, if you think about someone who starts the job today, it's going to take probably 2 years to get it where you're going to be in a position to open the asset. But beyond that, some of the municipalities today are very challenging, and it's going to take you 3 years. So I think, oversupply is not going to be anytime soon in terms of immediacy in the extended stay segment.
Isaac?
Yeah, when we started looking at this space, we looked at a data point that showed that while demand had increased at the lower mid-scale price point around 30%, we'd only seen an increase in supply of around 12%. While that delta is certainly changing slightly, we still believe there's a ton of white space, particularly underneath our Home 2 brand, which has continued to perform phenomenally well, which has created white space for us. And so similar to Gary, we'll keep an eye on supply and kind of market conditions, but not concerned about saturation at this point.
Liz?
Yeah, I completely agree. I think there is absolutely room for additional extended stay hotels. I think, yes, it's going to take 2 or 3 years to build one, and then I think in order to get scale, you're probably talking 5 to 10 years. So I think we have a little bit of runway.
Okay, thank you. Any questions yet? No? Okay. Let's have a look what the data says. I agree with all of you, by the way.
Good.
If these trees would get out of the way, I could explain this chart. Here we go. Okay. The average annual increase in supply over that period, which is 2000 to 2023, is the green line, and that is 5% per year on average. If you look at where we are now, we are at a very low point right there. In fact, I think last year was the lowest increase in supply for extended stay hotels since we started collecting the data in the late 1990s. And the year before wasn't much different. So what does it look like in terms of history? Look where the low point in supply growth was there, which was just after the 2008-2009 recession. It was actually 2010. So the next slide, I'm going to ask you to do some reading. Can everybody read that in the back? Is that print big enough? Or I can read it to you. I hid this slide from you guys. You know that. You said it's a new one. Everyone read fast enough?
Well, I think you've strategically placed these flowers so I can't see it. So,
I certainly can't see it because there's literally a tree in the way. But anyway, that's what that says. And that is highly unlikely to occur, certainly in the near term, but there is more in terms of historical data. What these charts really say is at the end of the last 2 years, the rooms reported under construction, only 1/3, approximately, of those had actually opened within a year. So the construction timeline is taking longer for varying reasons: interest rates, construction costs, municipal delays, and so forth. So that was the net change in rooms, and if we just look at 2022, there was about 30,000 reported under construction at the end of the year, while the net change in rooms was about 10. Similarly, in the following year, the same thing happened. Now, the last 2 years have been a little different from the longer-term historical trend. I mean, we've very high interest rates, we've got very high construction costs, very difficult getting labor. So if you look at it over a slightly longer period, which is 2016 to 2023, that number becomes 58%. So if you were looking at the big picture out there, and people have come to me quite alarmed about these pipeline and under construction numbers for extended stay, ask yourself the question, well, realistically, when are these going to open? And over 7 years of history on a national basis, 58% were open within 1 year. So again, we agree. The risk of national oversupply in the near term is very, very low. So let's do some questions about brands. Question for Isaac. What are the key differences between Hilton's Home2 Suites and Live Smart Studio brands?
Home2 Suites is obviously an incredible product, and we're incredibly proud of it. But it operates with a high 30% extended stay occupancy, and with Live Smart Studios, we're really targeting 65+% guests who are staying with us 30, 60, 90 days. A couple of other key differences, Home2 has a larger bay. Live Smart Studios feels a little bit more like a studio suite. We've got a super slim staffing model, which helps us out right now in sort of the labor challenges that we're dealing with. So 8 to 10 FTEs, no hot breakfast, so a simplified grab-and-go breakfast. And one of the things that came out in the data as we're doing, we've done a ton of research around this product and developing it to meet the needs of the consumer. 94% of the guests traveling for the stay occasions at this price point cook in the room. And so you saw us invest a lot of our time and resources into developing a really cutting-edge kitchen space.
Okay, thank you. Liz, which of the 3 ESA brands is the main development focus going forward, if there is any?
Yeah, absolutely. So really, we have 3 different brands. They all start with Extended Stay America. One, we have our Suites brand, our Select Suites brand, and then our Premier brand. And really, our focus is just to, at the end of the day, grow our brand awareness. So Extended Stay is purpose-built, as you mentioned, with the kitchenettes, and it's there for that longer-term guest. 80% of our guests actually stay 7+ nights, and so our goal is really to continue to grow our brand awareness and to continue to get people to stay at Extended Stay and understand what it has to offer.
And you, last year, you sold quite a few ESAs, right?
We did.
And is that still happening? I thought I saw some come as an email that's been offered.
Yes. Yep. So last year we sold about 50 assets. They were really some of our more lower performing assets. We are continuing to sell this year. We have another couple handfuls on the market today as well. Yes. And some of those we are selling branded. So we're hoping to keep them within the brand. And some of those we will sell unbranded. Okay. So it's a combination of both. But then we also have over 70 new builds in our pipeline right now. So we're really growing the brand both with new owners through a franchise model, but then also through new owners building new buildings throughout the country.
Thank you. Gary, what is your development strategy going forward? Because you're corporate-owned and franchised.
Sure, that's right. Early on, it was important as an owner-operator, and most of the brands today don't own real estate, but where we are, we do own real estate, so we have skin in the game. And so because of that, proof of concept is very important, and you got to put money into it to demonstrate that the concept does work. So early on, we focused really heavily on getting assets out of the ground up construction, proving the concept, tweaking the model, tweaking the construction prototype. And then as we did that, we began to move more into the franchise side. And so going forward, I think we'll continue to develop from a corporate perspective, but we've put in a lot more emphasis on growing the franchise side. In order to get the critical mass and do the things we need to do and create awareness is to improve the franchise growth.
So more through franchise growth?
More through franchise and continue to put skin in the game and continue to own assets as well, but a combination of both. But probably where we were heavily weighted, building from within, now working on more franchising.
Okay. And Richard, you developed a hometown and Red Roof dual brand, is that right?
That's correct.
And how's that being received and how's that going?
It's actually going very well. And before we get to that, Liz, keep selling those ESAs. We love them. Guys? Okay. No, actually, the dual brand, you have to kind of go back in time to where we started with our extended stay product, the Hometown Studios, is back in 2018. So it was the first time Red Roof as a company, who had been in business at that point 45 years, had introduced a new brand. So they were not only introducing a new brand, but getting into a segment they had never been in. So dual branding was not a high on their priority list. It was launching this new brand, getting the assets up and operating, and then having the franchise team take over and begin to develop. With that said, the concept was being pushed by our franchise community. We had demand from our franchisees. Some folks had large assets, 150 rooms, properties that were only running 50% occupancy, and wanted a way to fill up those other rooms. The beauty about us is we're able to do new construction because we have a beautiful dual brand prototype that we've signed new construction contracts for, but we also do conversions. So the conversions is the speed to market way to get these assets up and operating, and the dual brand concept really fills those rooms up. If our franchisees play by the rule book and they follow the playbook, we're able to get these assets up, opened and operating once they're renovated and hit the market running.
Okay, great. Any questions about brands? Do we hit all that? No? Everyone had too much lunch and the chairs are too comfortable, right? Okay. So why then, you go back to that earlier chart with the development, not that there's no development elsewhere, but the big focus in extended stay is, shall we call it upper economy, lower mid-scale? Shall we say it's a $70 to $120, $115 ADR range? Why is that? Why is the focus so concentrated there? Who wants to?
Yeah, so I think the focus is there because that's where the demand is. In order for the extended stay hotels to work, and by work I mean to be as profitable and to produce the cash that we are all underwriting, in order for that to work, you need to be able to be at a price point that attracts that 7+ guest. So a lot of times that's construction workers that their companies don't send them home every weekend, and so they're there for weeks and months. Some of it's traveling nurses still. And then there's a portion of it that's residential people, that people are living at the hotels either because they're in between jobs or in between places that they're moving. So we have found that when it goes higher than that 115, then you start losing some of that 7+ business. And when you start losing that extended stay, you also then lose a lot of your efficiencies and a lot of your profit. So that's where the price point is, that's where the demand is.
Yeah, I echo that as well. I mean, it's an extremely attractive price point, and we saw, as everyone did during the pandemic, these travelers continue to travel for these stay occasions that you just mentioned, and I'll echo your comments as well. We want investors to stay very hyper-focused on getting the mix of business right, really honing in on those 7, 10+ night stays, and that really leads to the efficiencies that you need to see the flow-through margins that we're talking about, and that's ultimately why the space is so attractive and why owners and investors are really looking at the space is because the profitability story is so incredible.
Profitability as well. Richard, you would...
Yeah, I mean, this is, in the economy side of this segment, this is affordable housing. I mean, this is a way for people who don't have credit, that don't have, can't go through a full background check and all of that, to be able to have somewhere to go to live. And if you break the model and you start breaking it down into more transient, it's not profitable. The whole idea is to fill the rooms up and have them stay long term. That's where you're going to get the most bang for your buck.
Gary, anything to add? Why the developments seem to be centered rather narrowly, perhaps?
Yeah, and I think one thing, I think it's important to remember that during the COVID, there was all these lower economy budget level extended stays that ran very, very high occupancies. And so got everybody excited about it, and people started rushing out to create new stuff. But, that's very price-sensitive customer. And as you go up, no matter what, in the food chain, and the rates go up, you have less length of stay. It's a fact. I can tell you because I've run 4 brands now, and it's happened that way every single time. And so that's something that I think people should be mindful. And I would say, without calling any brands, there's been a lot of extended stay brands rolled out over the years. Go back and look at the original press releases and see what they projected for their length of stay and see what it is today. I think you'd be surprised.
Okay, thank you. Did I see a hand raised, or was that tree again or something? Well, let's have a look at the background to the answers we got. And this clearly shows all extended stay hotels by the 3 price points that we have, how they performed during the recent downturn. And as you can see, I cannot distinguish colors, but I know the trend lines. The blue is the economy extended stay, lost far less RevPAR than actually any segment of the entire hotel industry. And the mid-price extended stay hotels, too, lost a little bit more, but not as much. Upscale extended stay hotels, sorry, Richard, I'm getting you with this laser. Upscale extended stay hotels lost more than the other two as a function of price as well, but none of them lost as much RevPAR as the overall hotel industry. So there is some, recession resilience there. And if you look at, the occupancies over time, over 25, 30 years, they're more stable than the traditional hotels. Do you have something you want to add to that, Richard?
Yeah, I think, we looked at where we were after the pandemic, and, there was this huge demand for the product. And I think right now we're just getting back down to reality. I think we're at that point where this is where we're going. I believe there's still going to be decline. It's not going to be crazy, but you will continue to see it, but it's just getting down to the normal place it should be.
Mm-hmm. And that's, if you look at I've got a longer chart here which details this over 20 more years, and you look at the trend lines for the overall hotel industry and extended stay hotels, they're very, very similar in terms of RevPAR change. And what this has done is, if you like, come back into normal. As you say, I mean, this was an aberration, very, very strong performance, though, for extended stay hotels. But things are sort of getting back to normal again. And if we look into the future, notwithstanding another shock like COVID, I think the relationships will be much closer as they have been historically. And another reason is, if you look at those RevPAR recovery indices back to 2019, look which two segments have the highest. They still do. Even though we were all back to normal now, they're still ahead. Economy and mid-price extended stay hotels, and you can compare them to all compare mid-price extended stay to all mid-scale, and it's done a lot better. You can compare economy extended stay to all economy hotels, and it has a much higher RevPAR recovery index. Not really trying to talk too much about that. as we're 4 years, away from 2019, going into the 5th year. But that still is a very strong reason why there's so much developer interest in here. And 4 years is about half the typical hotel business cycle of 7 or 8. So it's a very, very good performance. If you want to take a longer term view, because you're not building a hotel necessarily for just one cycle of 4 years, and this is the average annual change in RevPAR over the last 25 years with the 3 extended stay hotel segments compared to all U.S. hotels. And economy, slightly ahead, mid-price ahead. So this $75 to $115 ADR would probably be somewhere between those 2 segments. And even over the long haul, it has shown strength and consistency. Okay, economy segment RevPAR, now on the other side of the coin, declined 1.6% in 2023 compared to 22. And it was down more than 4% in January. Gary, do you think it's going to turn positive?
Well, I think January was pretty tough across the industry in general, and we're not in the economy necessarily with Stay APT. But February's gotten better, and I think the outlook will be better. But it was challenging to start out, and from some of those that have a large critical mass of the economy, it'd be worth understanding from their perspective why the decline.
Any thoughts on it? Is it going? Let me put some stats to back it up. You can see there that around about April of 2023, economy extended stay hotels showed negative change in RevPAR, and it rose back to almost parity, 0 change in October, and then came down again towards the end of the year, and then January was a 4% 2024 decline. I think January 2024, according to what I read, was very difficult for the construction industry, weather-wise, and we know that it's such a big demand generator. I think that had an impact. How's February looking?
February's looking better, and March is even looking better than that, so at least from our perspective.
And what about with the ESA, maybe ESA Select, because that's lower down the rate scale?
Yeah, absolutely. We are seeing February bounce back. I would agree with Gary. I think this year is going to be a little bumpy, but I do think towards the back half of the year, we're going to start seeing some more leveling off. And I think I don't know whether we'll end the year positive, but I think we'll end it pretty close to flat.
Close to flat. Any other comments on that?
No, I agree with that.
Any questions from the audience? Woke you up yet? No? So I can't really see out there. Well, looking at it, although economy extended stay hotels have suffered a bit in terms of RevPAR for 1 year, strangely enough, if you look back to 2019, nationally, the RevPAR actually did go down, which sort of got hidden amongst all the good news. But I believe that if 2020 had not occurred the way it had, that it would have gone positive the following year. Because it was going upwards, but then, of course, we all knew what happened in March, and everybody suffered, but economy extended stay hotels didn't suffer quite as much. But what this chart shows you here is over 10 years, the ratio of economy extended stay RevPAR to all economy hotels. And you can see that big spike. That really means that it lost far less RevPAR or revenues than the all economy hotels during 2020. And strangely enough, if you look at the traditional hotel segments, all economy was the #1 performer. So this shows that the RevPAR ratio has been increasing over time, that's over a decade, against traditional economy hotels. Why is that significant? Well, one reason is they have a lot of extended stay in them. That's where it tends to be housed if it's not in economy extended stay hotels. And this is not confined to only economy. If you look at mid-price extended stay hotels as well, they've been making very strong gains against all mid-price hotels. So with these gains and the 6%, the average annual increase in hotel extended stay hotel demand, sorry, tongue-tied, over the last 25 years has been 6% a year. And that's about 3 times what the overall hotel industry grows. So the question is, where has all this come from, and how long can these strong rates of growth sustain? Isaac, you're looking puzzled.
Well, we know from the research that these stay occasions, to your point, never stop traveling. So, all of the stay occasions my colleagues on the stage talked about, the traveling nurses, doctors, insurance claims, all of that kind of stuff kept happening. And we saw this in the strength of our 2 existing extended stay brands with Home2 and Homewood, who are running historically high RPIs, very strong occupancies. And we don't really see a slowdown in sort of, the current demand in the space. And so ultimately that, among other things, what led us to create a lower mid-scale priced brand in Live Smart Studios. So we're extremely feeling extremely positive about all the supply about all of the demand that's out there and it continue to grow.
So where do you think the demand is housed that is coming into new extended stay hotels that open up? Gary?
Well, I sort of equate it way back, when the first extended stay hotels came out, you remember back in the late 90s, when we did all the research, we were shocked to find out that all the extended stay guests were being housed at all the legacy full service hotels, the Ramadas, the Holiday Inns, the Howard Johnsons, which a lot of those are not even hardly around anymore. And that was the number one driver of an extended stay, because they generally had lots of rooms, and they all came over to when the extended stay product began to open, the ESAs, the homesteads, and the list goes on and on. Then you had another similar situation with, the Hamptons and the Holiday Expresses and the Comfort Inns. They started taking away from more of a full-service hotel. So I think today, extended stays become a lot more mainstream, and I think it's great we have some of the big brands, like my friend here at Hilton, that's opening these new brands or announcing these new brands to create a much heightened awareness for this product. And it's always been there, and people have heard about it. But when you have some of these legacy companies that start to say, hey, we're getting into this business, it's great because it creates that awareness. And I think we're going to see more and more, because after COVID, people realized, I want a like-home experience. And that means I want to be in a comfortable room. I want a kitchen if I don't feel like going out to eat. And that's what's changed, I think, from a mindset. It was already going that way, but that helped push it faster. And I think a lot of the places that had housed these extended stay guests, after COVID, speeded up and said, hey, listen, I want to move to one of those type of brands so I can feel like home in my stay. So I think it's going to continue to keep happening as the awareness gets out there, the newer brands and products get rolled out, and it's going to be a segment that's going to be reckoned with.
I think the other piece that sets extended stay away from some of your mainstream hotels, even like this hotel that we're in today, the Marriott Marquis, right, is we take demand from lots of different verticals, as opposed to being a group house or a L&R, national B2B type business house. So as fluctuations in markets happen, during COVID, obviously construction dropped, but we were able to backfill with things like visiting nurses and residential business. Now some of that business is going away, but the infrastructure bill is starting to take hold. And so now we're seeing that construction come back. So I think one massive benefit of extended stay is that we're not solely reliant on one type of business.
Yeah, and going back, I know we keep talking about COVID, but it for the extended stay segment, it had a huge impact, and it was twofold. One, it was coming from the awakening of the consumer, who at the time needed to find housing and shelter, and is continuing to use that model as affordable housing and be able to stay long-term without having those credit checks and everything I said earlier. But on the flip side, you also had the industry, the franchise community that was awakened. A big part of it was the Asian American community, that prior to COVID, there was a lack of interest in the extended stay segment. it was not as strong, nowhere near as strong as it is now. So it was an awakening. And that segment or that group is now looking and doing deals with folks like us on a regular basis, whereas 6 years ago they wouldn't be doing that.
Interesting. So the outlook for demand, I take it, is continued growth.
Yeah, I think it's worth noting, we continue to see even extended stay demand bleed over into some of our more transient brands like Hampton and Hilton Garden Inn. And, putting some new product out there that's going into a true extended stay product actually gives us an opportunity to grow those brands as well as they capture more of the higher rated transient business. So we're, again, I think it's a really exciting time to be a part of the extended stay mix.
Let's have another look, see what the data says. This is guest paid revenue for 7 to 29 night stays, so it qualifies as extended stay. I mean, most definitions say 7 consecutive nights. Some of the upscale brands prefer to use 5, which is no problem. For 7 to 29 night stays in the US, well, in extended stay hotels, they were $3.5 billion. In non-extended stay traditional hotels, they spent twice as much money. And the business evolving over the last 25 years, most of the business has been taken out from traditional hotels. Some has come out from the residential market for certain, especially at lower price points. So what that says is that there's still a lot of business there in non-extended stay facilities, perhaps paying more for the per night per room, because typically they don't discount as aggressively as extended stay hotels, and it's available there. That $7 billion does not include Airbnb. I don't know how much higher that would go with them, but I would think it would be fairly high. And we know that they have made an effort into extended stay. They started in 2020, and publicly they've said now X amount of our bookings are extended stay, and they've got an awful lot of product.
But this would make sense. If you go back to one of your original slides at the very beginning, you represented that the extended stay hotels only are 10% of the overall hotel room. So
yes,
it's just obvious that this is what you're going to see. We're just proved our point. Drop the mic.
Yeah, well, that's true. Well, the reason is now, if you looked at it in terms of percentage terms, the percentage terms would be lower. But there's 10 times as many traditional hotel rooms as extended stay or non-extended stay. That's why. So if we wanted to get up here and talk about SOC and stuff like that, those charts would be very different. But this is pure absolute numbers, dollars. And it also, if we go to the next slide, this is 30-night plus stays. In extended stay hotels, $3.9 billion against $1.9 billion in non-extended stay hotels. That's still a big amount there, but once again, that does not include Airbnb, it does not include VRBO, and it does not include corporate or service departments. As I mentioned at the very beginning, they require a 30-night minimum stay, and they usually require you to sign the lease. I don't know how much higher that would go, but the last time that we did the research for corporate apartments in the US, the data was calendar year 2017. That number was over $3.6 billion. So we know that I think it's bigger than the green bar there, but at this point we don't know how much. Any questions yet? It's nearly tea time.
Oh, good. There's a question.
We did get one, right? Where we go? Yes.
So, question I had, a lot of, we're comparing a lot of the economy extended stays to, apartments and how we, are full all the time, stay on waiting lists, low labor requirements. If you had the idea of buying an apartment complex and putting a choice flag on it, people would be like, what are you doing? But in the hotel space, everyone wants that brand. You see brands becoming maybe less relevant in the economy extended stay space, where you stay on waiting lists, people are calling you off the hook. How as a brand do you compete with people maybe saying, hey, I'm going to go independent in the economy extended stay space?
Liz, you want to have a go at that? You've got a very, very large brand of extended stay hotels. Pardon? Okay. Can we get a mic here? Because actually, I can bring you one. That was mine, hopefully.
Thank you. Appreciate it.
You're welcome.
So the question was, a lot of correlations are made with economy extended stays being very much like apartments with high occupancy, low labor. You stay full, maybe usually on a waiting list. If you were to buy an apartment complex, people would kind of think you're crazy to put a choice flag on it. But in the economy extended stay space, it becomes an expectation to put a brand on it. As a brand, do you keep staying relevant in an economy extended stay space where independents can just run a few $100 in Facebook ads and stay full? How do you compete there in the economy extended stay space as a brand?
So I think in the economy extended stay space compared to apartments, it's a different guest than it's a different guest staying at the apartment than staying in the economy extended stay hotel. Right? So we do have, north of 60%, 30 plus stays, and often those are individuals that are in between and can't afford an apartment. They can't afford first a month's last rent. They can't afford a cable bill. They can't afford electric bill, right? So that's kind of where the extended stay hotel comes in, is really as a stopgap. We did see not a lot, but some of our 30 plus business leave as we came out of the pandemic, because rents went down, and we called those folks and said, hey, where are you going? And they said, you know what, I'm now able to afford an apartment, and so I'm moving to an apartment, which for us is actually exciting, right? Like, our goal is to help our guests get to the next step, and that's kind of that space. I think the other piece is, with ESA, we have an entire marketing platform that is really dedicated to finding those 7+ guests. I mean, our marketing team is 100% focused on long-term stays. Sure, we get a transient room nights under 7 nights, but that is really just a byproduct of the fact that we're out there. So although I see it slightly similar, we fill a void that an apartment complex doesn't fill.
Yeah, we're not out there looking for apartment complexes to convert. I mean, our rooms are, limited size. It's all about efficiency. It's all about that. I think the second part of your question is, and Liz, you kind of hit on it here, it's about branding. And branding, it's the support that we're giving to the franchisee from a national sales perspective, from an operations perspective, from a PMS perspective, all of those things that you're paying your fees to help you build your business and maintain your business, not just finding a building and going independent and thinking you're going to make a go of it.
Thank you. Okay, we've got about 3 minutes. Are there any more questions? Do you want some more slides? Okay, slides. This is easy. Okay, this is not from us. This was a slide that I was at a presentation. It was done by Mark Woodworth. He's highly respected consultant in the industry. And it's just a sort of case of where are we today? What is the outlook? Well, we know that interest rates are extremely high. We're in an era of low supply growth. So if I can get this right, we're about here, 2024. And I don't really need to interpret that trend for you right there. A long upcycle ahead, possibly. And let's have a look. If we go to extended stay, if you look at that, and you look again, I referred earlier to sort of the low supply point, which is supply. Green? Yes. Which would be about 2010. Supply's blue? Then I'm colorblind, but is it? Well, okay. Demand is green. Yeah, you're absolutely right, because that went way up and down in COVID. Okay, but basically what I'm trying to explain is this is what you should be looking at. It doesn't really matter what the colors are, red or it's not red either, is it? It's green or blue, and perhaps that's where we are coming out from the low trough 2010, interest rates coming down a little bit, development, but no mass rollout of thousands and thousands of rooms nationally on one go. Steady increase in demand as well. And, you know, that's where we were 2019, and that's what preceded it. I mean, as far as I can see, that's the most logical outlook I can put. Anyone else like to comment on it? No? Okay, here we go then. And again, I mentioned to you earlier on the relationship between extended stay and total hotel RevPAR change over time. You look at it over a long period of time, and we're out of time. There's very, very strong similarities in the trend lines. 2020 upended everything, but if you look at the 3 lines after that, they're coming back together again. We've got forecasts, I think, 4 and 5% RevPAR growth for the overall hotel industry over the next 1 to 2 years. Typically, extended stay follows that or leads, whichever is your viewpoint. And that's it. I think we're done. Thank you to the panel. Thanks for coming.
Thank you.